April 15, 2018, the day Sears Holdings filed for Chapter 11 bankruptcy, marking the abrupt end of a 132-year-old retail empire that once ruled main streets across America. In a single, decisive moment, the once ubiquitous catalog giant fell beneath the weight of a strategy engineered by one hedge fund manager, turning a storied institution into a cautionary tale of ambition, mismanagement, and relentless market disruption. The story begins in 1892, when Richard Warren Sears and his partner Alva C. Roebuck opened a modest wagon shop in Minneapolis, selling watches, jewelry, and a handful of curiosities. Their revolutionary mail-order catalog arrived at rural doorsteps, offering the promise of quality goods at affordable prices to a nation still stitching together its own identity. By the turn of the century, Sears catalogs were as common as the American sunrise, and the company's brick-and-mortar stores began sprouting in bustling downtowns, cementing its position as a retail powerhouse. The post-World War II boom propelled Sears into an era of unprecedented growth. Suburban shopping malls erupted across the United States, and Sears became the anchor that drew families into these new consumer temples. Its iconic Sears Tower in Chicago, the world's tallest building when it opened in 1974, symbolized the brand's sky-high aspirations. With the addition of popular brands like Kenmore Appliances, Craftsman Tools, and the beloved Sears Auto Center, the retailer diversified its offerings, creating a one-stop shop that seemed invincible. Yet beneath the gleaming storefronts, warning signs began to flicker. The 1980 ushered in the rise of big-box competitors, Walmart, Kmart, and later Target, whose relentless focus on low prices and streamlined inventories eroded Sears' market share. While rivals embraced sophisticated data-driven logistics, Sears clung to outdated inventory systems and a cumbersome, decentralized structure. By the mid-1990s, foot traffic in many Sears locations was dwindling, and the company's once celebrated catalog sales were eclipsed by the nascent internet. In 2005, the turning point arrived with the arrival of Edward Betty Lampert, a former investment banker and the mastermind behind Essel Investments. Lampert, a fervent believer in value investing, saw an opportunity to acquire the ailing retailer at a bargain price. He orchestrated a $5 billion buyout, merging Sears with the struggling Kmart to form Sears Holdings in 2005. The merger was heralded as a bold rescue, a chance to combine two iconic brands under a single, revitalized banner. Lampert's vision, however, was rooted in financial engineering rather than retail renaissance. He pursued aggressive cost-cutting measures, slashing staff, shuttering underperforming stores, and selling off prized assets, including the iconic Craftsman brand to Stanley Black & Decker and the beloved Kenmore name to Transformco. These moves generated short-term cash flow, but they also stripped Sears of the very products and services that had defined its identity. The once vibrant catalog, a symbol of accessibility, was discontinued, and the company's real estate portfolio, its brick-and-mortar backbone, was sold to a real estate investment trust that later leased the same spaces back to Sears at higher rates. Investors watched with growing unease as Sears' quarterly earnings consistently missed estimates, while Lampert's Essel Investments continued to amass a controlling stake, extracting dividends from a company whose core business was hemorrhaging. The turnaround plan, marketed as a shift toward a digital-first strategy, never materialized beyond a token online storefront that paled in comparison to Amazon's meteoric rise. Meanwhile, the stores that remained became increasingly dilapidated, with empty shelves and broken elevators serving as visual metaphors for a brand in decay. By 2017, the warning signs had coalesced into an unmistakable reality. Sears' debt load ballooned to over $5 billion, and its cash reserves dwindled to a fraction of what was needed to sustain operations. In a desperate bid for liquidity, Lampert sold the remaining 20% stake in Sears' real estate portfolio, effectively turning the company into a real estate shell rather than a retail operator. Employees, once numbering over 1 million, were reduced to a few thousand, and the iconic Sears sign flickered on the Chicago skyline for the last time in early 2019, a mournful echo of past grandeur. The final blow came on October 15, 2018, when the bankruptcy court approved Sears Holdings' reorganization plan, allowing it to close an additional 142 stores and eliminate $7.3 billion in debt. The plan transferred the remaining assets to an ESL-controlled entity, effectively preserving the brand in a skeletal form but leaving behind a trail of abandoned storefronts, unpaid suppliers, and millions of displaced workers. The once dominant catalog that had reached into the farthest corners of rural America was now a relic, its paper pages gathering dust in archives. In the aftermath, the retail landscape has continued to evolve at breakneck speed. Amazon, Walmart, and a new generation of niche e-commerce platforms have redefined how consumers shop, emphasizing convenience, personalization, and instant delivery. The lessons from Sears' collapse reverberate through boardrooms worldwide. An over-reliance on legacy assets, the dismissal of evolving consumer preferences, and the perils of prioritizing short-term financial maneuvers over genuine innovation can dismantle even the most venerable institutions. Yet the story also serves as a stark reminder of the human cost behind corporate headlines. Former employees recall the camaraderie of working on the sales floor, the pride of knowing they were part of a company that helped families furnish their homes for generations. Communities that once thrived around Sears anchor stores now grapple with vacant lots and diminished tax revenues, underscoring how the fall of a single retailer can ripple across the socioeconomic fabric of towns and cities. Subscribe to The Collapse for more stories like this.